Is China, of all things, now the biggest worry for global markets? Everybody was so happy when China was going to reopen in December of last year because surely bringing back the world's second largest economy was going to be the saving grace in the middle of a rate hike cycle that was hurting growth otherwise, and a war in Ukraine that was making things that much scarier. Are we on the other side of that story now, where China is increasingly the risk to worry about? What does that mean? Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we are going to look at another set of sobering Chinese statistics due out later today, perhaps suggesting that the optimism we saw in the wake of the somewhat lower than expected CPI number out of the U.S. today is not something that has legs. Now, of course, we've had the conversation around China in spades over recent months. It has proven to be deeply disappointing in terms of its ability to deliver on a rebound for growth after that reopening. But the situation might get darker here as we go. So let's take a look at first what's going on, get an update on all of the moving parts, then look at what this data that we're going to be looking at, the trade balance report, the export numbers, the import numbers, what they're probably going to show us here, and then figure out what that means for global assets, be they stocks, be they commodities, currencies, rates, so forth. But first, a little bit of a status check. Here's the latest set of PMI numbers out of China. These are the CFLP numbers. These are official Chinese government statistics. And what you see here should be worrying. That surge that you see in the services and, by extension, the composite index, that's the reopening. Not surprising there, of course. You unlock a whole bunch of pent-up domestic demand and services surge. It isn't something that seems to have carried through, though. And so once that peaks out in March, you see now fizzling, deceleration. We're getting back to levels that seem to suggest that recovery is coming undone. Meanwhile, the rebound in manufacturing is looking even soggier, and for a couple months in a row now, this part of the story is in contraction. Just to remind ourselves, in the logic of PMIs, 50 is the center line at which the index in question isn't pointing to either growth or contraction. Above 50 is growth, below 50 is contraction. If you get below 50, the further you go, the lower you go, the faster that contraction. And what we can see here is that the manufacturing index has been lingering in contraction territory for a few months now. If we look at the Caixin version of this, this is the private sector estimate of the same PMI data. It's a little bit more anchored to smaller enterprises. The official numbers a little bit more anchored to large state-owned enterprises. What you see is a very similar story. Again, in March is where services tops out and starts heading lower. The composite index largely follows suit. What you then see on the manufacturing side is nominally a little bit better, but at the same time, shallower. So we're basically flat. Manufacturing isn't growing. But the pop that you saw after the reopening looks much less significant, much less pronounced here than it looks here. And even here it looks modest. more so here. So the overall story seems to be that whatever pent-up demand was released when zero COVID lockdowns ended in December and the Chinese population was allowed to re-engage with the economy both at home and abroad, whatever that pop was, it might now be gone, and we might now be unraveling, at least in terms of growth rates. You get the sense that that's in fact what's going on from anecdotal and high-frequency data. This is something that we look at quite frequently here. This is a 5-city average of the metro traffic for the biggest urban areas in China. And what I've done here to get rid of some of the noise is just take a 20-day moving average of the average. And so what you see here is, indeed, when the economic reopening begins, and with some understandable lag, there is, in fact, a surge in activity. People are coming out of lockdown. They're starting to move around. Metro traffic in the big cities goes up. Not surprising there. That's a pickup in economic activity. Notice, though, that once you get to pre-COVID levels, so about the 8 handle on this index, and because this is an average of an average, you don't really want to get precious about the numbers. It's more the direction and the level. But you'll notice this right here is about where we were before the plunge that was the COVID outbreak. You're right around here again and stalling. So in other words, whatever dividend there was to be extracted from reopening as far as domestic demand is concerned looks to have been used up already. It gets worse. You might expect that there is, with the reopening of the world's second largest economy, a pickup in money flows. Try and take advantage of that reopening, and also money flows from China unlocked and seeking opportunities now that the barriers to economic activity from Beijing have been relaxed, at least as far as COVID restrictions are concerned. But you're not seeing that either. This is volumes cumulatively, the turnover going back and forth, southbound and northbound, on the Shanghai Hong Kong Stock Connect. What this is a way for people that have access to markets in Shanghai to trade shares directly listed in Hong Kong, and vice versa, for people with access to Hong Kong to have the ability to trade shares listed in Shanghai directly. In other words, what this is an outlet for global markets to participate in mainland stocks and for mainland investors to participate in global markets. What you don't see is a pickup in volume that might be consistent with the sort of money flow you would anticipate with rejuvenated economic activity. This seems to be idling. So there is no money, it would seem, behind this reopening. It is struggling to get off the ground. Why is that the case? Well, rocket science this is not. Consider that by the time China reopens in December of 2022, the peaks in catch-up growth in its largest export markets, the ones that it depends on the most, the Eurozone and the US, has long since peaked. What we're looking at here are composite PMI numbers that capture both manufacturing and service sector activity. And you can see that there is a catch-up surge in growth after the worst of the pandemic in the US. And that catch-up peaks in May of 2021. In Europe, it's a little bit later. That peaks in July and ostensibly at shallower levels. Of course, the fiscal stimulus and generally stimulus on offer in the U.S. was much more generous, and so there is an understandably bigger upswell there. But you can see both of those upswells crest long before China comes back to the game. And of course, by the time it comes back, in both of these areas, policymakers have been busy raising interest rates. So not only is the knock-on effect from COVID-era stimulus done, and not only does that fizzle out by the time China comes back, central banks are actively pushing the other way. So when China comes back around and says, hey, everybody, we're back. We're ready to sell you things. We're ready to be the middle node in this global supply chain again. Well, the demand is just not there. And so their recovery never really gets off the ground once it has to rely once again on external demand, because that internal pop from the reopening is spent. But wait, it gets even worse. Because with China being absent for nearly a year longer than its main end demand markets, those end demand markets had to diversify supply chains. There was, of course, already an impetus to do that. We know that there's been a growing tension between not only China and the U.S., but China and the West. Not only between China and the U.S., but China and the West in general. There we go. But there was a very practical reason here. China was just not a reliable value-add sort of location at a time when it still had roving lockdowns. So, understandably, there was some diversifying away. And you can see that this has been reflected in a loss of market share. So China's share of global exports has declined. China's share of global imports has declined and has been trending lower. What we get here is the sense that not only is external demand for what China is trying to sell waning, but domestic demand, depending on economic growth, that's not really making an offsetting difference here. It's actually going the wrong way too. And what you find in total is that relative to the peak at 15% share of world economic activity, let's call it world trade turnover, which is what this is, the sum total of global exports and imports, just to get a sense of overall activity. The share that's taken up by China has significantly declined from 15 to 11.2%. And we can see that barring the very, very most recent data, this is as of February, so ostensibly this has gotten worse since, what you see is that the contraction in the trade picture in China year on year is looking worse than it is for the globe at large. So what this is, seemingly, is China being de-emphasized and losing its ability even to compete in this space. Now, of course, this does not change the fact that China is the world's second largest economy. It does not change the fact that it has very, very commanding infrastructure to be this value-add economy, this middle of the supply chain provider where it sucks in raw materials and takes then goods to some sort of either finished or semi-finished space, or takes in semi-finished goods and brings them closer to being done and ships them on, or finishes them and ships them on. It's still a critical value-add node in the global supply chain. But the extent to which it dominates that space, has meaningfully reduced. And that, of course, doesn't bode well. Now, authorities in China have tried to push back against this. They've tried to offset it. And over the past several weeks and months, they have introduced an absolute flood of stimulus. It's come in primarily monetary forms. We've seen an assortment of China's benchmark interest rates cut, be they the prime rates, be they the loan refinancing terms faced by property developers, be they the reserve requirements for banks. There's been a tremendous amount of stimulus, and we just saw it in spades with a relatively higher than expected loans number published just this week. But when we look at it in year-on-year terms, when we look at how much new capital is actually coming to the fore to lift this economy, it looks quite paltry relative to history. So this is total loans year-on-year as well as new loans year-on-year. And you can see that there's really not the kind of dramatic upsurge in financing that you would need even to engineer a flash-in-the-pan expansion at the pace that China needs to shake off these cobwebs. There's been a little bit of a pickup from May into June, but looking at the pace at which capital is coming into the system, it does not seem like there's enough stimulus here to really get things moving. Now, Chinese authorities have, of course, said that there's more coming, but the markets seem dubious that they can actually do anything here and that this stimulus can be effective. Consider how the yield curve has moved. Since the reopening, not surprisingly, there's been disappointment. And so you can see from the big dashed line to the solid line, there's been a meaningful flattening. There's been a move lower. The market is saying China is going to have to run rates that are lower. It's going to have to be more accommodative. The overall financial conditions posture is going to have to be more dovish, because clearly this recovery is not doing what Beijing wants it to be doing. Clearly things are not growing like everybody would want them to be growing. And so more stimulus to be expected. Note, though, that when you compare the current setting, which is that solid line, to where it was last week, we've actually moved in a little. And that's probably not because things have gone better, because there's been no evidence to suggest that they have. Not that I've seen. Instead, it looks like perhaps the market is saying, well, there's not much more stimulus that's probably coming, because there's not much that stimulus can reasonably be expected to achieve. You might be trying to juice domestic demand with a flood of new spending. But the problem here isn't domestic demand so much as it is the external picture. If there isn't a robust export engine to power Chinese growth, it's unlikely that anything done domestically can truly offset the malaise here. China is a deeply globalization-dependent economy. And unless it can participate in global markets and be the kind of quintessential node in the global supply chain that it has been in recent decades, then much of its positive, often extrapolated story goes away. And we can have a conversation about the long-term structural risks of that happening invariably anyway, because, of course, China's population is now shrinking, and being the low-cost value-add center becomes very difficult when the key commodity you had to get you there a mass of people seems to be going away. But in the nearer, more tradable term, what the market seemed to be saying here is a bunch of stimulus was needed relative to where the reopening started to occur, but there's not confidence that a bunch more of it is coming from last week into this week. So maybe the market is considering Chinese authorities have gotten closer to about what they're prepared to do, and it's not really having the effect that they'd like for it to have, at least not yet. And a sense of futility maybe is setting in. With that in mind, here's the data that we're actually going to be looking at as it crosses the wires. The actual headline trade balance number is perhaps not the most important here. It's really the import and export numbers and the implications they carry for both domestic demand and external demand. And here the expectations are sobering. We're expecting another negative number on imports, another negative number on exports, and most worryingly on the export side, it looks like things are going to get worse. A deepening decline. Down 10% year on year in June. Imports expected down 4.1% in June. That's a little bit of an improvement versus the 4.4% decline the last go-around in May. But clearly the trend lower here is very much intact, and the markets are understandably looking at this and saying, well, this is evidence that we have a worrying story, and perhaps an increasingly worrying one, at a time when we can ill afford it. What's more, Chinese economic data has increasingly underperformed relative to baseline forecasts. So not only is the picture dark, but it's actually darker when you look at reality than it appears when you look at baseline expectations. These are collated from economists, typically by the likes of a Bloomberg or a Reuters, where they take in the collective views on a given piece of economic data from a mass of market-watching economists and analysts and strategists, throw them all together, get a median, and then that becomes the expectation against which we all say XYZ number was better than expected, worse than expected, in line with expectations, and so forth. What you see in this city data is that Chinese economic outcomes have increasingly underperformed by an ever wider margin relative to baseline forecasts. So analysts here still have their models set to a rosier view of China than reality has actually endorsed. That, of course, means that the expectations for today's releases, that negative 10%, negative 4.1%, might also be coming out of models that are overly optimistic. And that sets the stage for maybe a disappointment on even these sobering numbers. That, of course, bad news for China, but the larger story is it is perhaps most scary for the global business cycle. Much of the hope at the start of this year for a soft landing in most of the world's major economies was, in fact, reopening in China. The return of the world's second largest economy, the uplift that that would provide to global growth. Well, there's not much uplift to go around here, it would seem, at a time when central banks in the US, in the Eurozone, in the UK, are increasingly talking about inflation that isn't falling as fast as they'd like, and inflation expectations that are stickier than they'd like. As a matter of fact, we had a surprise interest rate hike from the Bank of Canada again this week. Now, the markets were leaning toward that hike occurring at some stage between this month and September, and ostensibly the likelihood was probably on the sooner rather than later side, so it's not terribly shocking. But for China to look this week at a time when global central banks, and in particular the Fed, are still very much in rate hike mode and still very much focused on driving growth downward, the unraveling of this reopening seems to do a whole lot to increase the risk of a broad global recession, and perhaps a more severe one than is currently being bargained for. Hence, rosier models being shown to be too rosy by this index. If we look at the latest set of global PMI numbers, we can see this in spades. There's a dramatic decline in global manufacturing. It is now shrinking at levels unseen even during the pandemic. If we look at what we have on services and the composite index, that's showing us that with China rolling over, so has the global picture overall. At this point, we are net in contraction mode for the composite reading. Notice it is just barely under 50, 49.9, but let's say we're optimistically idling, pessimistically already in contraction mode on global demand. So if these numbers coming out of China follow this pattern, and what we end up with is these being undershot and the numbers looking more dire still, then the likelihood that this is going to keep moving in the wrong direction seems that much greater. So just mere hours after the markets were celebrating a softer U.S. inflation number, ostensibly around the hopes that maybe the Fed would start a rate cut cycle sooner next year, very telling there that the likelihood of a rate hike at this month's FOMC meeting and the possibility of one at some point in the back half of this year didn't really budge on that number, but the markets cheered anyway because it looked like the markets could envision cuts happening as of March next year rather than May, which is where we were before the CPI report. If all of that optimism is faced with this, well, then the reading of those numbers may look quite different. And the markets may come away saying, you know why inflation's lower? Because growth is flagging. And that's no good news for corporate earnings. Not in their total, not for the market as a whole. And with that in mind, we could be looking at significant downside risk for shares and for cyclical assets. And in particular here, the Australian dollar stands out as something that is very China sensitive. China is Australia's largest export market. Australia is also the provider of deeply cyclical commodities for China. Its biggest exports are coal, think energy, and iron ore, think the smelting of steel, which goes into so much of what China builds, both domestically and for export. So when you look at these numbers, if they do in fact underperform expectations, if it is in fact as dark as it might well be looking at these leading indications, then if the Aussie starts to fall, if local shares start to fall, if the yen continues to build higher, then the reading that you might see from global markets as we digest the 1-2 punch of U.S. inflation and then this data might be, this isn't good news. It's bad news. We're getting into a situation where global recession looks more likely and more widespread. And that might very well be a tough hangover after a spirited rally for Wall Street. With that in mind, that's Macro Money for today. I am here as ever, Monday through Thursday every week, right after overtime, a show that we do with Chris Vecchio, head of Futures and Forex here at Tasty Live, breaking down the day's events and trying to make sense of what's coming up next. I'm on again with Chris for Futures Power Hour on Friday, on with Tom and Tony for First Call on Sundays, writing for the News and Insights portion of tastylive.com, writing for Luckbox Magazine, and opining on Twitter at alias PBAC. Thanks very much for joining. See you tomorrow. Happy trading.